5, 2020, the 529 tax penalty. This is the 39.6 Facebook Live Finance Show, also now streaming live to YouTube. This is the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, childcare, and even the car you drive. Today we're going to do a quick 5-minute Friday episode, which usually means 6 or 7 minutes. Thank you to everybody who joined yesterday. There were a lot of people here for the 529 talk. I'm always surprised when some certain topics bring a lot of people into the episodes. A lot of people are really interested about 529s. And just as a recap, yesterday's episode was why we don't have one. Primarily is because we live in Texas where there's no state tax and there's no tax deduction. Also, you can't self-direct your investments and can't invest in real estate. So here's another one. I didn't get to it because I wanted to spend more time on it. For very high earners, this is a potential substantial problem, especially if you fill up a 529 with a lot of money. Let's pretend you invest $150,000 over the course of 15 years. And then by the time your kid goes to college, there's $300,000 in the 529. Then your kid gets a scholarship. Fantastic. People always say, what if my kid gets a scholarship? So, if you get a scholarship, there's a special provision that allows you to take money out without paying any penalty. Fantastic. But there's still a penalty that is not really considered a penalty because of the way a 529 is taxed. So let's pretend your child gets a $300,000 scholarship, everything paid for, private school, room and board, even maybe public school with room and board will be $300,000. So you don't need any of that $300,000. You don't want to save it for graduate school. You don't want to pass it on to anybody else. You don't want to use it for cooking school. You want to take the money out. So let's pretend you take all that money out. What will happen? You put in $150,000. That money was all after-tax money. It's not Roth money. Don't confuse it with Roth. It's after tax. So you can get that $150,000 back without any penalties. The other $150,000 was gains. You put in $150,000, it gained another $150,000. You pull all of it out. $150,000 you put in is called your basis. That money was already taxed before. You pay no tax on that. The extra $150,000, the gains, you have to pay tax on this. How much tax do you pay? A lot of people think it will be taxed as capital gains. It is not taxed as capital gains. It is taxed as ordinary income at your marginal tax rate. If you had just put that money in the regular taxable brokerage account, you would have had to pay taxes along the way with dividends. But the capital gains would be taxed as capital gains, at most 23.8%. Here is taxed as ordinary income. At the federal level, that's 37%. Plus, you potentially have to pay state tax on it. For example, if you took a state tax deduction, you could have to pay that tax back. So a taxable account can be much more favorable than a 529 plan, especially if you're at a high tax rate and you're potentially taking gains out at very high ordinary income tax levels. If your ordinary income tax is like 12%, not a big deal, but at 40% is a huge deal. There's no tax loss harvesting inside of a 529. Okay, it is tax efficient on the way in, but you can't generate any losses. So you can get in trouble. Now, if you're taking money out and you don't want to take all of it out, let's just say you want to take out $150,000 of it, 150,000, the 150,000 you put in, there's another catch. You can't just take out the $150,000 that you contributed and leave the 150,000 of gains in there. In a Roth IRA, you can do that. You can make contributions and take out your contributions penalty-free, tax-free, and leave the earnings in there. You can't do that in a 529. It has to come out pro rata. That means if 150,000 went in and you have 150,000 of gains, so it's 50% contributions, 50% gains. If you take out $1,000, half of that, 500, would have to be basis or contributions, and the other half has to be earnings. For every dollar you take out, it has to come out pro rata to the proportion in there at the time of the withdrawal. So if you want to take out 150,000 of it, 75 would be basis, not taxed. The other 75 would all be gains and be taxed at your marginal tax rate. Crazy. A lot of people don't know this. But when you get a tax form for this, you get a 1099-Q, I believe, and that just gets thrown on as other income on your 1040. It does not go on to Schedule D, where capital gains is. So it's taxed as ordinary income. It's a huge, huge, huge penalty. Now, if you were to take money out that is not for a qualified use for school, then not only do you have to pay the ordinary income tax on the earnings, but you're also going to pay an additional 10%. That's the actual penalty. So if you're at the 37% bracket, you're paying 47% on those dollars. So yeah, it is not liquid money, as in you can't just access that capital. If you try to take money out of it, you're going to be taking out part of it that's basis, that's fine, but the part that's earnings, you're going to be paying your marginal tax rate plus 10% extra tax. You would have been way better in a taxable account. So you don't put money into a 529 unless you plan to use it only for school expenses. And if you have money in 529, don't super overfund it. You know, there's if your kids get a scholarship or whatever, or unless you're planning on moving that money to another person who's going to be able to use it, you don't want to have too much money in there, because the tax of the extra can be way worse than having it never gone in there in the first place. All right. I got to switch. I keep forgetting to look at the chat box. All right. Glad I stopped the 529 funding. So maybe this applies to you, maybe it doesn't. But yeah, if you have too much in there, or if any of these pertain to you, just be careful. Just know what you're doing with it. And thank you very much for coming. Yeah, why don't they tell us this? Nobody tells anybody. That's why I'm here. Okay, so anytime you use an account with a special name, you should know why you're using it. It should be distinctly better than the alternative, which is always a taxable brokerage account. If you're using an IRA, 403B, 457B, anything, you should be choosing that you're using one of those alternative funds or alternative buckets because it has some benefit to you. Now, if you need to put it in there just so you don't blow it, yeah, then that's a good reason to have it. But can you think about, imagine if they had an account for everything. Let's have special accounts for vacations, special accounts for saving up for a car, special accounts for weddings. I mean, they just happen to make one for college. But each state's program is different. It's so complicated. But without these plans, a lot of people won't save. So it's probably good for a lot of people. Maybe not. All right. That is it for our 9-Minute Friday. Until tomorrow, episode number 83. I think we're going to cover a bunch of taxes this week because it is tax season. All right. How did I know this? I look these things up because I don't know the answers to them. And I'm like, I got to figure this out. And so I look things up and yeah, I find out the answers. And sometimes I just find them in forums. Other people ask similar questions and I read through the thread and people who know more than I do put answers. And then, like you guys, I'm like, oh my gosh, how did I not know this? Why didn't anybody tell me about it? And then I remember it because it's like blows me away at how important this is, but most people just never talk about it. Also, if you note, most financial advisors, they don't make money on 529s. So it's not something they sell. You don't hear about things that financial advisors don't have because those are the people who are out there promoting, trying to make money, right? When's the last time you saw a commercial on a 529? Right. Okay. Good night. This is not legal, financial, accounting, any other advice. Until tomorrow.